Welcome to Quiver Financial's market update for March 2024. Find out what we're seeing in stocks, interest rates, metals, and oil. I'm Colby McFadden with Quiver Financial, joined with Patrick Moorhead and Justin Singletary. Gentlemen, welcome to March of 2024.
Quick question would be if you go back to call it the 40s to the 80s, that was a time of rising interest rates. Obviously, the 70s saw the bulk of that. And then if you look at from the 80s basically to 2020, we've had nothing but interest rates going down. I know we talked about a range, but do you think in the macro picture, the really longer range stuff, that interest rates are in this time frame of where they just are going to continue to, they might sit in a range for a period of time, but do you think that they may tick up over time based on just looking at the history?
That's an awesome question, because what we just talked about was what you would call the short to intermediate term time frame, months to a year, right? Like that's what most people are worried about in their portfolios. How am I performing over months to a year to 2 years, 3 years? They don't really go much longer than that. They don't pay attention for that. And what you're talking about is, what if we're in this secular move where 2020 was the low, historic low, and now from this point forward, we just keep going higher. And in the chart, what that would mean is that you have 5 waves, 1, 2, 3, 4, 5. You get a 3-wave correction. And if we start to get the things that I'm talking about happening, if you got another 5-wave move after this, then Justin, you're dead on. This was a historic low. Now we're higher for longer. And what could cause that? Well, the last point on this slide, expect the unexpected and keep in mind the long-term demographics, because we have a situation that baby boomers, right now 11,000 or 12,000 people hit 65 every day. For my whole career, everybody was saying, oh man, when the baby boomers retire, they're going to sell all their assets. They're going to get conservative. Guess what? Wrong. They're retiring and they want more risk. They're the ones who want NVIDIA. They're the ones who want all the high risky stuff, because they're like, hey, I got to make it now, baby. So they're not getting conservative. They're not selling their houses, right? They're 65 is not 65 anymore. Like most 65-year-olds are as spry as a 40-year-old. I know 65-year-olds that are in better shape than you guys. Sorry to say, but, so it's like 65 is not what it used to be, right? So that you're not seeing the baby boomers slow down. And then right behind them, you have the millennials. And the millennials are a huge spot. You guys, Justin, you're a perfect example. You just got married. You're going to have a kid. You're going to start a family. You're going to buy a house. You and everybody in the 10-year gap around you is doing the same thing, and it's a huge population. So it's hard for me to believe that the Fed can be too accommodative, because if you look at the 70s, when all the baby boomers were of household formation age, commodity prices were getting pushed higher, energy prices were getting pushed higher, interest rates were being pushed higher, shelter prices were going up with it. So demographically, maybe we are set up between the baby boomers staying in the game and the millennials coming into the game, that you just have so much demand for natural resources, and you have so much economic activity that the Federal Reserve doesn't have to lower rates to save the economy. Because remember, the last 40 years, they were lowering rates every time the economy slowed down. So maybe we've got a demographic mix over the next 20 years that changes that. We'll see. We'll know over the next 2 years.
Just because a 65-year-old like yourself has more hair than Justin and I does not mean that they're in better shape.
Well, I'm not 65 yet, but I'm starting to feel it. I got a little pinched nerve somewhere in there. All right, so here's the thing. Interest rates, if we do find that Goldilocks range that the market thinks that we're in, which I hope we are, then when we come over into the stock market, this is what we talked about in January. We said right now, and